Good morning and good evening to all of you, and thank you for joining us for this ONFIF virtual panel on government deficits and central bank financing, which forms part of a series of ours which looks at the longer term implications for the world economy and of course financial markets. My name is Adam Cotter and I head up the Asia office of ONFIF here in Singapore, and we're very pleased to have a real stellar lineup of speakers joining us today. Given time is short, I will spare lengthy introductions, but today we have joining us Jesus Felipe, who's advisor to the chief economist at the Asian Development Bank. Good morning, Jesus.
Very good morning, Adam.
Scott Fulweller, who's associate professor of economics at the University of Missouri, Kansas City. Good evening, Scott.
Good evening.
And Mangal Goswami, who's the Executive Director at the CSEN Center in Malaysia. Good morning, Mangal.
Morning. Morning.
Now, to manage and have the best flow of the conversation, Jesus and Scott will begin with a presentation, which will be followed by a short discussion between the speakers and myself. We anticipate this taking around 30 minutes altogether, and we will use the remaining 30 minutes for Q&A with our attendees. So we do encourage and welcome participant interaction during the Q&A, and please do feel free to ask questions via email, and these can be sent to angelia.lee@onfif.org or through the chat function, and the chat function is in the top right corner of your window next to the question mark. When asking a question, please do introduce yourself. It's always good to know where the question comes from. And we also kindly ask that all participants place themselves on mute when not speaking to reduce disruption. We also kindly ask this is also a good time to remind you that this will be an on-the-record conversation, and you can also subscribe to receive our updates by going to onfif.org/subscribe. Now, as we all know, ministries, treasuries, and central banks around the world are funding large amounts of stimulus to combat the effects from the COVID-19 pandemic. We're here today to discuss the real-world operations of central banks and treasuries, and to take a deep dive into government deficits and public debt. So I would really like to start by handing over to Jesus and Scott to kick us off. So over to you.
Thank you so much again, Adam. Very good morning, everyone. I think it's very, very important in following with the point that Adam just made, to ask the question of why it is important to demystify what central banks and treasuries are doing today. Our view, this is something that some of you may not share, is that there are severe misconceptions about the effects of running fiscal deficits. I think we all have learned at different levels that fiscal deficits lead to a reduction in savings, that they crowd out the private sector by raising interest rates, that they're inflationary, etc., etc. I'm gonna put here my screen and confirm that this can be seen. All right. Can you please confirm that the screen can be seen? Can it be seen, Adam?
Unfortunately, I just get to see ourselves, not your presentation. Angela, is there an issue with the platform?
I've made Jesus a presenter already, so it should work.
So if Jesus launches his presentation, there.
Yep. I'm doing my best to do it right. Is it okay now?
Looks good.
All right, thank you so much. So I was saying that we think it's important to really clarify some of these misconceptions. Where do we think that these misconceptions arise from? I think they mostly arise from two things, two sources. One is the training that we all got by way of different versions, some more advanced, some more primitive, but of the so-called loanable funds model. I'm gonna go very briefly over it. So this is one point. The second one is either ignoring or not knowing what central banks and treasuries do, in fact, in real life. And this is the second point that Scott and I are gonna get into, because we think that it's important that everybody knows what central banks and treasuries do every day, how they operate. This is not technical, but we think that it's very, very important to have some understanding of these two issues that are fundamental in order to understand and to really, in particular, have an assessment of the discussion that we are having, which is in the context of the crisis, central banks, governments are funding, in particular, central banks are funding governments. So what are the implications? So what am I going to do? What are we going to do? Very simple. I'm going to start with what I think are some primary misconceptions, as I was saying. What do they come from and why we think that incorrect? Then we're going to talk a little bit about the inflationary dangers to central bank financing of government deficits. Very, very briefly, I'm going to touch upon it, whether it's true or not. Then I will talk briefly about whether deficits lead to unsustainable debt and currency depreciation. So the presentation is very quick, and I'm going to close with a couple of implications for policy. All right. So let me get to this. Why do we think that government deficits are unsettling to many people? And I think that there are three commonly held beliefs that really support this idea. The first one is that government finances are almost identical to family finances. That is, that there is also a budget constraint. You and I have a budget constraint. The government has, quote unquote, the same budget constraint. We argue that this is incorrect. There's a big difference between you and me and what the government do. And this is that we are not currency issuers while government are currency issuers. So immediately, this can make a significant difference between what governments do and what you and I can do. That's point number one. Point number two is the idea that deficits lead to crowding out of investment, private sector investment. And this already comes directly from the loan fund model that I'm going to talk in a second. And number three is also directly from the loan funds model that budget deficits, fiscal deficits lead to higher interest rates. And what I want to show you is that in real life, it is actually exactly the opposite. The budget deficits put a downward pressure on interest rates. So I think these three misconceptions are fundamental out there, and that really lead to this idea that government deficits carry negative implications, or many negative implications. Okay? So very, very briefly, I assume everybody must have seen at one point in his or her life these two curves: the demand for loanable businesses and the supply of loanable funds by savers. Supply and demand intersect, and that determines the interest rate in the economy. The interest rate. Now, what is the effect of a budget deficit on this setting? What the budget deficit does is shift to the right the demand curve. Okay, so the difference between both of them, the old one and the new one, is the government deficit. What is the implication of this story? Two things. One is that it's a new level of investment to the left. You see here, so from I0 to I1, so much lower than the previous one, significantly lower. And the other one is that there is an increase in interest rates. This is the essence of the loanable funds model, and this is what people have in mind when they start arguing that there is a crowding out effect because investment goes down because interest rates go up. This is the essence. There might be fancier versions of this story, but this is the essence. Okay. So the question that we ask is it true that budget deficits lead to higher interest rates, and do governments and private sector compete for funds, seeing that they are fighting this idea of the crowding out effect? And we argue that this is not true, that the loanable funds model has nothing to do with the reality, but what happens in reality, which is, I insist, that deficit pushes interest rate down, and that if there is any competition for whatever amount of funds out there, it's not government and private sector, it's the dealers who compete among themselves, not the government. So since the presentation will be available to everyone, I'm not going to read everything, but what we are going to argue is that the loanable funds model tells us something that doesn't square with the reality. Okay, so what happens in reality? Well, to understand what happens in reality, we need to go to the bookkeeping entries of the government, central bank, private sector bank, and households and businesses, the T accounts of each of them, because they are linked. They are linked in such a way that every time the government spends, which is basically sending a check or electronically crediting somebody's account, it leads to an increase in the private sector surplus. This is simply the bookkeeping and accounting of the government, central bank, and households. There is an increase in this case for 100. So fiscal deficits increase the aggregate supply of reserve balances. This is immediate. This is what is happening on a daily basis every time the government credits somebody's account, be it a civil servant when the government pays his or her salary, or being hundreds of millions of dollars to pay for a road. Okay, so this is very, very important to keep in mind. But there is more to it, which is when the government deficit immediately increases banks' reserves held at the central bank. This is the bookkeeping entries that occur immediately at the central bank and the private sector bank. So what does it happen? Well, what happens is the following. A government deficit, I just said, credit reserve banks. Immediately, this puts a downward pressure on the interbank market rate. So this is exactly the opposite of what the loanable funds tells you. In reality, the deficit means excess reserves in the system, and it puts a downward pressure on the interest rates. So given that the central banks today operate with an overnight interest rate to manage their monetary policy, what do they need to do to prevent this from happening? Well, of course, they issue bonds to drain these excess reserve balances, and that is what they are doing permanently. What is the amount of the bond issuance? Of course, it's the budget deficit. So you can imagine, what this is really happening when we observe that there is a bond issuance, is that basically from the point of view of the private sector, what we all are offered is trading the available funds that we all have in the pocket, cash, let me simplify, for a T-bill. That is, you give the government your cash, you get instead a piece of paper that says in 3 months I give it back to you with 3% interest rate. Where do these funds come from? Of course, it's the government's own deficit that supply the dollars or baht or peso necessary to purchase the bond. And you will realize that in the end, in net terms, there is no change in the quantity of reserves in the banking system. So this is the reality of what is happening every single day. And this is the effect of a deficit, which is contrary to what the loanable funds model tells you, is to lower interest rate. So in reality, this story of the crowding out has nothing to do with what happens in reality. I insist, deficits add to private saving. Government running a deficit is what happened. The best thing that can happen to any of us at the private level. You basically be very careful the day the government or your government starts running a surplus, because it means exactly the opposite. I insist that deficits do not put upward pressure on interest rates, but downward pressure. And this is because in a corridor framework, which is what I explained, the government must sterilize the deficit reserve to maintain the interest rate that it has announced. There is a very important implication. Scott and I really believe that domestic currency government bond sales are functionally interest rate maintenance operations and not really financing operations of the government. Okay. So what we believe it happens is that, and this slide summarizes the whole story of what is going on, the central bank, government, bond market, etc., is that even government officials do not see the whole picture. This is because quite often they are really concerned with the direct mandate, their parcel of the whole story. So you are somebody is in the finance ministry or in treasury and is simply looking or concerned with the right-hand side of this picture. And they really believe that they are borrowing from the market. Somebody's in the central bank and is absolutely or simply concerned with the interest rate, inflation targeting, the Taylor rule, etc., etc. And most people do not really see the whole picture. For example, the implication that this has for the private sector, which is immediately, and because of the bookkeeping operations, the book government deficit means that or implies a private sector surplus. I think this is really important. Basically, what we put here is that it all depends on how one looks at things. Okay. So let me go to the second point. The second point is something that is very much discussed today, which is the inflationary dangers, in particular of central bank financing government deficits, which is what some of the central banks in our region are already doing, for example, Indonesia and the Philippines. Let me summarize. I already showed you in the previous slides that when governments issue bonds, there are two operations. One is the government spends, and this increases the excess reserves in the banking system. Okay, this is the bookkeeping operation. But the second one is that there is a bond issuance to drain these excess reserves, and I explain why. And the reason is that otherwise the interest rate the interest rate of the central bank would go to zero, potentially. Since this doesn't happen, it's really basically the reason why this doesn't happen is the bond issuance. So one is canceling the other one. So that is impossible to have inflation out of this, because while it is true that the government is spending, at the same time, government is also issuing bonds to drain this excess liquidity. So if you observe inflation, which is perfectly possible, it cannot come from here. If there was inflation, well, what should it be in countries like Japan or the US, that they live in a permanent state of fiscal deficit? How much will inflation be in these countries? Or you mean hyperinflation, a la Zimbabwe? We can talk about these things later. So this is, if you want, the normal case. What happens if instead the central bank directly finances the government, what people call, right or wrong, monetization? Is there any difference? And we think at the end of the day, there is no difference, because if the government doesn't issue a bond to drain reserves, it is the central bank that does it. The central bank issues its own interest-bearing liability. The term I highlight here in yellow is exactly what this is called in the Philippines, which is a term deposit auction. And this is basically a slide that Scott and I used to explain a couple of weeks ago with the Philippines, the BSP, the central bank, has done with the treasury. They issue something called term deposit auction. So whether it's the government or the central bank, at the end of the day, the excess liquidity caused by the deficit has to be drained to maintain the interest rate around ISR in the slide. So very clearly, whether it's bond sales or central bank loan to the government, there is something being issued. In the case of the government, we call it T-bill. In the case of the central banks, we call it term deposit facility. In the case of the Philippines, and both are issued at approximately the central bank's target rate. For all practical purposes, this doesn't matter. In both cases, the recipients receive the funds, and this doesn't have any serious implications. I mean, difference, macroeconomic implication. Absolutely the same operation from a practical point of view. So we are not saying that there cannot be inflation, even from a deficit. What we argue is that the deficit can be inflationary if this is too big or too poorly targeted. Of course, yes. But this has nothing to do with how the deficit was financed, whether it was the government or it was the central bank. Nothing to do with it. It is simply because it is too big. In other words, you reach capacity and the government continues spending, by all means, like any other spending. Where else can inflation come from, in particular in emerging economies and before full employment? Well, you have plenty of supply side bottlenecks. You have migration from the countryside that, for example, puts upward pressure on the price of food, wages increasing faster than productivity, or businesses higher markups. All this is perfectly possible, okay? And these are sources of inflation. Deficits, are they unsustainable, or do they lead to unsustainable debt and currency depreciation? Well, yes, deficits have to be paid. When somebody issues debt, this has to be paid. What we argue is that domestic currency debt service is always a policy variable, and we can talk about it. Of course, yes, developing nations can experience currency depreciation, and central banks may raise rates to defend against this. We don't deny this, absolutely not true. However, what we question is the immediate causality that sometimes we read from an alleged cost of credibility because there is a budget deficit to severe depreciation. We question that causality. It is not so simple. Actually, it's far from that. Okay. This is, in fact, what we have done here is to graph the peso, baht, and rupiah exchange rate vis-a-vis the US dollar. And what you could see that this has nothing to do, for example, with what happened in 97, 98. In fact, since in particular in the Philippines and Indonesia, the central bank intervened. If anything, this has stabilized the market and even has led to an appreciation of the currencies with respect to what was going on before. Of course, this has been achieved with swaps, etc., etc. That means that the system is working. But if the situation were outrageous, like in 97, 98, we wouldn't see this level of stability. Okay. So let me finalize very quickly. What does this mean for policy? But let me reiterate what we have said. The fiscal deficits, of course, financed or funded in domestic currency, which is implicitly what I've been talking about, very clearly create a private sector surplus. They do not lead to interest rate increases. They certainly do not crowd out the private sector, and are inflationary only if they are too large or poorly targeted. But this has nothing to do with the financing method. There is a perennial question that appears here, and we can talk about it later, which is the debt is transferred to future generations. And the question is, well, yes, somebody needs to pay, but we also need to understand how this happens, a relationship between interest rates and growth. Debt is basically the accumulation of the deficits, and in the form of this type of documents. Of course, these documents probably do not exist anymore. Debt is already is an electronic transfer. But basically, what we ask here is why wouldn't you or me in the private sector want this? We hear often the need for a government to eliminate debt. Look, listen, you cannot be on both sides of the river. You want to eliminate debt from the system, you need to give up these documents, which are part of your wealth in the private sector. You need to eliminate this. You cannot eliminate only the debt of the government, but not eliminate these papers that you, or these documents that you own. There have been a couple of instances where governments have tried to eliminate debt. Maybe Scott can tell you later. There is a very interesting country, country tried to do this approximately 20 years ago, and Scott can tell you what happened to this country. The same country, in fact, did it around 100 years ago. It eliminated all the debt in its economy around 100 years ago, and I insist my co-author Scott can tell you what happened to that country. We argue, and I finish here, that the problem in today's crisis is not the fiscal deficit. We argue that the real problem the crisis may lead to is the health of the private sector. Why? Because when the private sector is in deficit, this signals a crisis. What we argue in particular for many of our emerging markets in the region is that absent a current account surplus, governments will need to run a deficit for the private sector not to be in deficit. So you need to choose exactly what is you want. But let me repeat this because it's important. Those economies that will run a current account surplus, of course, they don't need to run a fiscal deficit. But I insist, for those that do not manage to run a current account surplus, governments will need to run a deficit if they do not want the private sector in deficit. So what we argue here is you better understand how to manage a fiscal deficit and don't be scared. Some very quick conclusions. We have argued that we believe that there are misconceptions about how central banks and governments operate on a daily basis, and this leads to really somehow unwarranted concerns for how to pay for deficits. Okay, Treasury and central bank coordination imply that deficits do not lead to higher interest rates. The idea of printing money really is not how it happens in real life. This definitely does not create inflation precisely because of the coordination between Treasury and central bank. As to deficits and debt to GDP ratio, we argue in the end that is a political choice. If there is a government or a country out there that thinks that what is acceptable is a zero deficit and a very low debt to GDP ratio, do it, and then you will see what happens to your economy. In particular, in the context of the crisis, it's a political choice. Okay, let me finalize with making the following note, just in case somebody that has not understood it. We have not claimed that all deficits are good and carry no inflation risk. We haven't said that. I have not said that. I have not said that domestic currency debt does not need to be serviced. I have emphasized quite the opposite. I have not said that there are no caveats for developing countries, economies that have legitimate concerns about currency depreciation. This has been admitted. And I have not said that one can trust government fiscal policy decisions. Again, I stress that I have not said it. Adam, I want to stop here. Not without thanking everybody for having listened, and we look forward to the discussion. Thank you so much, everyone.
Thank you, Jesus. It was a great start, and look forward to the ensuing discussion as well. I just want to, on the slide about the exchange rates, do you therefore see that the current system of dollar swaps and all these other tools that we have around is going to prevent us experiencing any level of instability that we saw back in 97, 98? As you say, it seems to be a lot more stable in this crisis.
Yeah, let me quickly answer, and then Scott can elaborate. My view is not. I think the way, when I have been asked already this question, and the answer is, how much longer do you need? It may happen, but somebody would have to tell us when will this happen. We're already 3, 4, 5 months into the crisis. Governments began intervening, central banks began intervening already months ago. In the case of the Philippines, it was in March. So I'm open. Somebody will have to tell us, look, at beginning this particular date, you will see a severe, massive depreciation of the peso or the rupiah. So my view is that no, this is not going to happen. I don't know if Scott would like to add something.
Well, let's see. Let's see. I'm sorry, I just lost my thought. Not every country has the, there's a hierarchy of swap lines, and it's a fairly new system and so forth. But it's definitely quite different from what we had in 97, 98. You could have a situation where you have some hiccups along the way, but it would seem that there's a definite push to make sure that you don't have a shortage of the key currencies.
Thanks, Scott. Well, I just want to ask you a quick follow-up question. I mean, Jesus gave us a few ideas as to why, but why do you really think it is that central banks are so misunderstood?
Well, let's see. So we're still with me, huh? Okay. Well, I think, Jesus was talking about the training that economists get. And one thing that we're generally taught is that monetary policy and fiscal policy are two ways of affecting aggregate demand. And we generally don't go further than that, except we talk about, say, central banks control the money supply, and that's what drives inflation, and you have to take some of the stuff out of the hands of politics, the political business cycle, sorts of stories, and so forth. One of the things that gets missed is what Jesus was going over, which is that we have two different effects on the financial positions of the private sector from monetary policy and fiscal policy. Fiscal policies, deficits directly add income. Monetary policy can create spending by largely creating spending out of existing income, lowering interest rates, getting people to borrow more, etc. So we hear these terms, printing money, or the central banks flooding markets with liquidity and so forth, and it's not what they're doing, in the sense that they're not directly creating income. And so some of the misunderstanding is basic accounting, that printing money is not what's happening, in the sense that you're just dropping money from a helicopter. You are adding to reserves, and then you are also supporting your interest rate target somehow. And that's quite different from the typical story.
Yeah, no, that's very true. Amanga, I'd like to bring you in here, and perhaps you may want to add a few more things to the questions around direct financing compared to indirect financing of budgets, but also perhaps a bit around the dark arts of quantitative easing and monetization as well.
Yes, thank you, Adam. Just I wanted to add a little bit more to the demystifying some of these myths from a slightly different lens. Budget deficits, as we know, can be financed either domestically and or externally. When it comes to domestic financing, we have banks, we have non-banks, and then we have the central bank financing. This central bank financing is the part that is called direct financing. In other words, central banks buy government bonds in the primary market. In normal times, such activity can be called, which is called monetization, can be associated with inflationary consequences in normal times. Yeah. Typically, what history has shown and validated is that these kind of direct financing, especially for what we have seen in developing countries, is that it can lead to something called fiscal dominance. Fiscal dominance is where the borrowing program of the government is so significant that it impinges on how the central bank conducts its own monetary policy with operational independence and independence of its instruments, in the sense that the borrowing program can lead to some kind of pressure for the central bank to accommodate the large fiscal borrowing. It can also put some certain measures on banks, where banks may have to have large holdings of government bonds. which can be in the form of statutory limits. All in all, basically this borrowing is doing is that it's creating a bigger fiscal dominance, and what we have seen is that can sort of come in the way of the central bank using carrying out its own mandate of inflation, of price stability. What developing countries have done, especially the market access countries, they have evolved over time, and they have handled this fiscal dominance issue with what we call, there has been a lot of direct prohibition of direct financing of the fiscal deficit. You have that in countries like India, Thailand, Malaysia, Indonesia, and the likes. So this means that direct financing is prohibited by law, but at the same time, this does not mean the central bank cannot engage in buying government bonds in the secondary market. Central banks, in fact, do that all the time through open market operations and the likes to maintain its balance sheet inventory of government bonds. But there is a difference. When the central bank, when commercial banks buy them, when the central bank buys them from commercial banks in the secondary market, then bank reserves go up, right, from a balance sheet perspective of the central bank. When bank reserves go up, the central bank has the option of sterilizing this, which was partly alluded to in the earlier presentation. So that way, the creation of bank reserves can be managed through sort of a sterilized operation where it's partly offset. In case of direct financing, the case is somewhat more nuanced, it's somewhat more different. Here, you can consider it to be as sort of as a direct creation of money, and as soon as the government starts spending, you see high-powered money going into the economy. So let me connect the first part to the quantitative easing. Quantitative easing, by and large, what has been practiced is likely where the central bank expands its balance sheet beyond the normal operations to go and buy government bonds or other securities. In this case, let's talk about government bonds from the secondary market, and it expands its balance sheet, and it can then further go ahead and sterilize that through various liability operations, such as interest on its reserves or other issuance of its own liabilities. So this is how sort of quantitative easing comes in, and necessarily quantitative easing is not monetizing, but often it's confused with monetizing. It can lead to monetization, but at the same time, it's mostly done through this kind of a channel, as I said. So what EM central banks have been doing, given this crisis in the very first phase, is where they actually have gone in to expand their balance sheet to purchase government bonds in the secondary market, mainly to sort of manage the risk of the financial dislocation that was taking place. So that was the first operation that in emerging market central banks and even advanced economy central banks did. They were providing liquidity of last resort, providing liquidity in the government bond market, because in a lot of emerging markets, foreign holdings of government debt in local currency is significant. And as foreign investors started shedding these bonds as capital outflows, this is where the stress came from, and that's why central banks have gone in and sort of looked at and provided liquidity in this market and intervened in this market. Now, in the second phase, as things open up and as we look at economic stimulus, this is where the narrative is much more where the markets are thinking, are emerging markets or other developing markets constrained in their financing of this massive deficit that may be building up because the economies are in such distress? This is almost unfathomable. That's why this narrative of deficit financing or monetization is coming up, where that third sort of pillar, which is the central bank financing domestically the budget deficit, is now on the table. And the markets are discussing this. So the question now is, what are the risks to this? And very quickly, I will say that, well, emerging markets have gone a long way in undoing some of this fiscal dominance, right? And this is enshrined in the laws. Now, if we undo some of these advances, then there's a risk that that may be taken too far, and fiscal dominance may come back to rear its ugly head. So even if it were to be done, the markets would be more amenable if it's done in a more measured way, temporary way, with clear exit strategies, and not for too long, and the amounts need not be too big. So that may be how this process can be managed, if at all, if this is the route that some sovereigns may take. So I think, you know, the removal of some of these impediments to directly borrowing, as they are temporarily removed, we have to be very careful to make sure that these are not taken and misused, and fiscal dominance again comes back. So that's where, and then we will probably see markets sort of putting pressure, you know, selling the currencies and the like. So that's where I think the whole narrative is going. So I'll stop there.
Oh, thank you, Mangal. Maybe if I can just follow on quickly. Of course, central banks in other major economies have been engaging in QE for quite some time now, and it's been generally found acceptable, both to politicians, but also the populace as well. And there hasn't been much in terms of inflationary consequences or any impacts on central bank independence. So given that we're in such an unprecedented crisis now, should emerging market central banks also should consider doing the same to save their economies? And if they did, what would be the risks?
So as I said, I think the emerging market economies in the first stage have already engaged in some kind of an asset purchase programs to stabilize their, notably their bond markets, the financial markets. This was the first step. The second step, as the financing situation of the government sort of becomes more and more stretched, you know, there may be a case where some of these, you know, direct financing may become be something that may be put on the table. So clearly, these have, you know, that said, I think, given that the situation of the economy is so stark, aggregate demand, there is a huge amount of slack in aggregate demand. In that sense, such operations where direct financing with very limited sort of scope, temporary, lower in scale and volume, may have some merit in that sense. So, and in fact, you're seeing some of this happening in some of the countries where some of the laws are being relaxed slightly, just to give that window. So I think the jury is still out.
Great, thank you, Mango. We are receiving questions from our listeners, but I'm just going to sort of intertwine them with the questions I have, because there's a lot of overlap as well. But I want to move back to Jesus and Scott. One of the questions I have for you is really about which types of instruments should be used, and which institutions should be responsible, and who should be the recipient. And this ties in with two questions that we received. There's one from Cedric Remor, who is the ASEAN Program Manager for Climate Bonds Initiative, who would like to know a bit more about what ministries of finance, treasuries and central banks have in their toolkit to green these stimulus packages. So what green tools are available? And then we also have a question from Rajiv DeMello about the possible role or impact that longer maturity bonds could have on this as well.
May I start? Thank you. Yeah, let me quickly take some of these questions. There are plenty of things here, all of them very interesting, Adam. And a little bit elaborating, taking from what Mangal left it. I would believe, or I do believe that these measures, extraordinary measures, will last as long as economies are not recovered, and governments will retreat as soon as the situation improves. I think the key question here is what outcome do you want in your economy? That's what I was pointing out before. Well, let's assume that you want to balance your budget and you want to have in the extreme a zero debt ratio? What do you think is going to happen? In particular, you need to think of something that Scott was mentioning. What will happen to unemployment in the private sector financial positions? And I think the consequences will be extremely negative. So one thing is that instead of thinking about fiscal deficit as something very strange here, as an alien to be destroyed, think of it as a tool to pursue the public interest. We do believe that the crisis, we hope the crisis ends soon, and which means that the private sector positions will be restored, and this will translate into lower fiscal deficits to cover the gap. What is the limit to all this story? Government directly intervening or through the central bank? I think it's inflation. But the limit is not the government's ability to spend money. It is inflation. In the case of fiscal policy, I think what is very interesting is how many central banks and governments have come to recognize during the last 10, 12 years since the crisis, the previous crisis, and even more so since the start of COVID-19, that fiscal policy is a necessary part of the macro policy mix. I think it would be interesting if everybody read the interview in the Financial Times of only a couple of days ago to Sri Mulyani, the Indonesian finance minister, what she said very openly. So for many economists, this is more related to a return of orthodox Keynesianism. However, I think we think something is slightly different. And this is that in our view, this goes well beyond the story of standard Keynesianism. Once you recognize that fiscal and monetary policies, as Scott was saying, have different implications and effects on the financial positions of the private sector. Fiscal policy increases the private sector spending out of an increased quantity of income. Monetary policy increases the private sector spending out of the same income. This is very, very important for people to differentiate. Consequently, the appropriate policy mix between, cannot be selected without referring to the financial positions of the private sector. Just remember that after the financial crisis, 10, 15 years ago, the private sector was left with a huge overhang of debt. So if financial positions do matter for the policy mix, then you really need to consider which policy choice will fix those debt-heavy financial positions the fastest and the better. And I think Scott and I are arguing that a fiscal policy really needs to be very seriously considered. I will stop here.
Maybe, Adam, if I can just have a few words on the green finance and the long, very quickly. I think it's important that this recovery, sort of factor in and take this opportunity for the green recovery. And that way, in terms of central banks, one possibility is, embedding, green finance collateral as part of their collateral framework. That's one sort of very sort of micro sort of measure that central banks are thinking of. And on the long-term maturity of bonds, I think one important issue is that for emerging markets, the yield curve, the liquidity in the yield curve at the long end of the maturity spectrum is limited. So yield curve control may be of some essence in the sense of the central bank being able to do that. But that said, I think there is a significant increase in the issuance of local currency bonds at the longer end of the maturity spectrum over the last 10 years. So that may be a possibility of using some kind of a yield curve control.
Thank you, Mango. It does seem to be going in the right direction. I just want to go back to one of the points from the presentation about the debt to GDP rates, which are both, I suppose, politically and culturally also driven. I mean, in a time of crisis like this, there's always a question around who will pay the bill eventually, and is there ever going to be such a thing as a free lunch? We talk about the issue of debt socialization for future generations. I mean, perhaps, Scott, you may want to answer this, but the way I see it is hopefully if borrowing today is used to finance a faster recovery than would have happened otherwise, future generations will benefit. Is this going to be the case, do you think?
Well, in terms of what they use it for, I can't speak for what governments are going to use it for, but certainly, again, in the domestic currency, the interest rate is a policy variable. So you always have the ability to refinance that debt. So in terms of future generations paying, I think where the point that you're saying comes in is where future generations pay is if you don't have growth in the meantime, right? So I mean, there's two ways to get rid of debt, right? To lower the debt to GDP ratio. You've got the numerator and the denominator. So and at least for the richer countries, the standard way to lower that ratio is to grow GDP rather than to pay down the debt itself.
And what does all of this mean for central bank independence? Is it increasingly becoming clearer that sort of in times of crisis, this independence is a myth of the past, or did it even ever exist? Jesus?
Oh, this is a $6 million question. You're opening Pandora's box with this question, Adam. I think it's very, very important to really understand the literature and the idea of. Let me make my point clear, and I agree implicitly with part of the point that you were making. It's a myth that central banks are ultimately independent. This is something that was introduced in the literature sometime in the 60s, 70s, definitely in the 1980s. All this took over, and it was a part of a larger change in economics and how economics was conceived at the time. Ultimately, the idea was to insulate monetary policy from political decision making on the belief that it would foster the well-being. Okay, so why this question today? Why the question of independence? Well, it is the idea that elected government may force central banks to stretch the limits beyond their mandate. The theoretical mandate is really price stability. I'm going to talk about this in a second, in giving you an example. So yes, I do believe that central bank independence is a grand myth around the idea that governments cannot be trusted not to create accelerating inflation as a result of political machinations overriding economic responsibility. The example that I was going to give you is what happened, for example, in the European Union during the previous crisis. This is a case that I know very well. Is the case of Spain. In 2011, Jean-Claude Trichet, at the time the president of the central bank, sent a letter to the Prime Minister of Spain at the time, Mr. Zapatero, with the following conditions. Before I tell you the conditions, it's very important to tell you what the Article 127 of the European System of Central Bank says. It says basically that the mandate and only mandate of the European Central Bank is to maintain price stability. As simple as that and as clear as that, and I give you the article number. Okay. In 2011, Jean-Claude Trichet sent a letter to the Prime Minister of Spain. Okay, basically asking him to do labor market reforms, to take care of the deficit, and to undertake product market reforms. So this is the independence that exists. So it's very, very difficult. I don't even think it's even at a point necessary for reasons that I think Scott can elaborate, which is really about the coordination of fiscal and monetary policy. So yes, to really come to the answer to your question is, I don't even think in real life a central bank independence does exist.
Thank you, Jesus. Yeah, of course, well, as we know, in Spain and other Euro countries, the government decided they wanted to join the Euro and then therefore had to abolish their own domestic currencies. So the central bank was, you could almost argue, effectively abolished with that move as well. But obviously, the mandates are constantly changing. I think we can have another session talking about central bank mandates, and that's something that we do look at very closely, and whether they should really only be worried about maximum employment and price stability, because it's quite ironic that historically most central banks have really been blamed for not spotting crises, and then when these happen, they get rewarded with greater powers. And it seems that they continue to extend their remits beyond their basic mandates into broader financial stability issues as well. I just want to go on to some of the questions we have from our listeners as well. I thought we may miss this question, but I think we should bring it in. This is a question from Su Fen Lee, who's at the Ministry of Finance in Singapore, and they would like to get the panel's views on MMT, a school of thought that has been gaining traction since, over the past few years.
MMT.
Modern monetary theory. Mangao, maybe
Okay.
you're a learned scholar on this. Perhaps you may want to offer some thoughts.
Clearly, I'll just say a very few words on that. Clearly, you see, narratives like helicopter money and the likes. So under the current circumstances, where the situation of aggregate demand is really severe, I think people are talking across the spectrum of anything, whatever it takes. But that said, the notion of MMT has its limitations, and especially in the context of emerging market countries, I think emerging market countries have come a long way in terms of establishing credibility, some degree of independence of, operational independence of central bank and the likes. So I think, it's a difficult sort of idea for especially in emerging market central banks.
Scott,
can I jump in on that one?
Yeah, please do.
Can I jump in? So I happen to teach PhD macroeconomics at the only university in the world you can get a PhD from MMT economists. So I have a little bit of background in this topic. So first off, I will just say MMT is far more nuanced than most any discussion I've seen occur with it. There are like about 500 academic publications in MMT over the last 20 plus years. So to narrow it down to something like MMT is print money or run deficits, et cetera, the people who say those sorts of things don't cite MMT because they won't find that in MMT, actually. 99% of the stuff I see about MMT never quotes, never cites, et cetera. So like I said, MMT is far more nuanced. It's largely historically a description of how the monetary system actually functions. And I would say the vast majority of what we've seen happening, first off, 2008, 2009, with central bank actions, fiscal policy actions, and what we're seeing now, confirms pretty much what MMT's been saying for 20 plus years in terms of how things work.
Thank you, Scott. Is there anything to add?
No. I think Scott is really the expert on MMT, so I would not add. He really teaches a PhD course. I would simply underscore the point that he made is that you hear sometimes criticism of MMT, and the criticism often has nothing to do with what MMT claims and what is based upon. So I think this is very, very important.
Okay, well, maybe we can. I do have a question from your presentation. This comes from Rajiv De Mello as well in Singapore. In your list of causes of inflation, should we not also add exchange rate depreciation, which would be a consequence of both QE and debt monetization?
Well, yes and no. I have already argued that in practice there is no monetization. Monetization is a term that people use as a matter of calling it monetization, not a problem. In practice, let me summarize what I have argued. By monetization, somebody means what? The central bank printing bills and handing out like this. There's nothing to do with that. I just argue that governments spend, and governments spend not by printing money and handing out cash out of the window. Governments spend through electronic transfers to accounts. That's point one. This creates excess reserve in the system, and then this has to be drained. So this idea of monetization, at least that way, please dismiss it. As to the story of where could the depreciation of the exchange rate comes, of course, yes, and that is already pointed out in my in the presentation that we gave. But I think much of this may come probably from the current account, the developing country running a current account deficit, and that this forces the developing country to depreciate, etc. But we think the story is much more complex than that, and we admit it. What we are saying is that this doesn't come from the budget deficit. It comes from the current account deficit, and this is really what forces developing countries often to end up having contractionary policies. And then it is true that, of course, what you do not want is the government spending more. In fact, what they need to do, what they are asked to do, is to cut. So yes, I admit it's absolutely true that there is a depreciation, but not from the deficit, at least directly.
Maybe if I can add, Adam, here, I think for emerging market countries, the exchange rate channel is becoming a very important financial amplifier. I'll give you an example. Notably, in the local currency sovereign bonds, government bonds, there has been a significant increase in foreign ownership of local currency bonds, right? In countries like you see Thailand, Indonesia, Malaysia, and you have across in Latin America as well. So what has happened is during this periods of capital outflows, when foreign investors some of them are unhedged, when they withdraw capital, it puts an extraordinary pressure on the exchange rates. And then the exchange rate, although as a sovereign you have issued a liability in local currency, but at the same time the investors are dollar denominated investors, and when they withdraw this, there is tremendous pressure on the exchange rate, and that amplifies the domestic financial market stress. So, and there's a lot of work that BIS has been doing on this. So this is clearly a very important channel of amplification for emerging market countries.
Yes, that's very true, Mangal. So we have probably time for one more question from our attendees. This comes from Prashant Pandey, who's at AMRO in Asia, not the bank, but the regional research organization. How can central banks unwind their balance sheets, and what are the risks associated with this? Developed market experience shows that it may not be too easy. This is a question to all of you, so feel free to jump in if you.
So I guess I will start. The question is, why do you want them to unwind their balance sheets, right? I mean, some of it will happen naturally, right? To the degree that there have been loans from the central bank to step in to, say, money markets and lending markets where those have been disrupted. Once those are up and running, central banks will leave and the loans will eventually run off the balance sheet. Beyond that, I mean, you've got currency as part of what the central bank is sterilizing, and so a currency demand. And so with currency demand, you're going to have just natural growth in the central bank's balance sheet. We've added all sorts of additional liquidity requirements. And so say in the US, where reserve requirements at the time that Lehman failed were about $10 to $15 billion. Today, they're somewhere in well, it depends on estimates, 900 billion to 1.5 trillion, right? So, I mean, if you really want to shrink central bank's balance sheet, get rid of the liquidity coverage ratio, that would have some significant effect there. So, so the growth has been natural to a large degree. Natural is not really the right word, but natural in the sense that they're stepping into markets that aren't functioning. They have additional regulations, and then there's also the issue with, as Mangal was talking about, where they're doing QE because they're concerned that the interest rates on, say, across the yield curve, or in particular markets like in the US, mortgage-backed securities and so forth, may not be exactly where they want them to be. So to the degree that those issues get rectified, I think central banks wouldn't see as much need to have their balance sheets really large.
Jesus or Mangal, would you like to add anything to that?
Thank you. Very quickly. I think it's a very interesting question that I think there are two arguments that are behind this idea of central banks see the need to be smaller. And one is crafted in terms of inflation, the other one in terms of efficiency. However, both of them are very, very unclear to me. On the first one, the story of inflation, I think what happened during the last 10, 20 years should be proof to everyone of the belief that the size of the central bank balance sheet is somehow necessarily linked to inflation. Absolutely not true. Balance sheets have really increased dramatically in some cases, and no, this hasn't really led to any inflation. And on the second one, the story of being efficient or inefficient is, I think we need to recognize, at least for the second time in the last 10, 12, 15 years, central banks around the world have really taken the vast majority of the money markets and a significant percentage of credit markets onto their balance sheets. And there is a broad consensus that this is necessary, even though not everybody would agree. So I think the lesson, as Scott and I put it, is what you allow to happen in an expansion is what you will take on the next crisis. So these are the arguments that are very unclear to me.
Mango, any last thoughts from you on that? Or?
Very quickly, I think, there are two ways of doing it, I guess. One would be your normal sort of monetary policy operation where you sort of think about raising interest rates as the economy recovers. And that's one way of one approach. The other would again be, the balance sheet as your assets run off. Of course, there is an issue of liquidity, and I think there a very important issue is having the right instruments for central banks to be able to manage that process as these assets run off. So that can be very challenging. So unwinding the balance sheet, as we have seen the earlier examples from advanced economies, is not as it's harder than one thinks of. So I'll stop there.
Okay, well, thank you, Mango. Thank you, Jesus and Scott. I've just noticed the time. We've come up to our allotted 60 minutes. It's gone very quickly, but thank you for that. And I do hope we've been able to demystify some of those issues that we set out to at the beginning of the talk. I know we're getting more and more questions about MMT now. So Scott, I can see a sideline show with you maybe in a few weeks' time on that. And there's also more on the mandates of central banks, which we're very happy to talk about. And we need to convene a panel to discuss that. There's a point we received from one of the attendees saying that Ulrich Binzel at the ECB has a paper and a book that claims that central banks have remained opaque about what they do for decades as a way of avoiding accountability, calling it the reserve doctrine. So maybe we can do a session on that and see how that lies as well. But once again, thank you all to the speakers for joining us and taking your time this evening in the US and this morning in Asia. And thank you all for listening in as well. And wherever you are, please stay safe. Thank you.